When you get a mortgage, your lender is probably going to offer you mortgage protection insurance. Most people sign up for it without thinking about it, and it's costing them thousands of dollars they don't have to spend. Because mortgage protection insurance is one of the most profitable, least questioned, and genuinely unnecessary insurance products being sold to American homeowners right now. And there's a dramatically better alternative that almost nobody knows about. Mortgage protection insurance, also called mortgage life insurance, has one stated goal: to pay off your mortgage if you die or become permanently disabled before the loan is paid off. On the surface, that sounds reasonable. You don't want your family to lose the house because you're gone. But here's where it gets predatory. The cost is usually between $25 and $150 per month, often on the higher end, which is $300 to $1,800 a year, sometimes more, depending on your mortgage amount and age. For a 30-year mortgage, that's $9,000 to $54,000 in premiums you'll pay over the life of the loan. And the truly maddening part is that you can get dramatically better coverage for significantly less money with a simple term life insurance policy that you could have gotten yourself for a fraction of the cost. Most homeowners don't realize this option exists. They don't know they could have shopped for better coverage. They just signed the MPI paperwork at closing because the lender presented it as a normal part of the mortgage process. By the end of this video, you'll understand exactly how this trap works, why it's so profitable for lenders, what the better alternative actually is, and how to make sure you're not throwing thousands away on inferior coverage. Before we go further, if you want to actually understand the financial traps hiding inside normal financial products that almost everyone overlooks, this is exactly what this channel breaks down every week. Subscribe now, because what I'm about to show you next is how to save thousands on insurance coverage and ensure your family is protected if the worst happens, and most homeowners have no idea this option even exists. Let's start with the basics of what mortgage protection insurance actually is, because understanding the product is the first step to understanding why it's a trap. Mortgage protection insurance is a decreasing term life insurance policy sold by or through your mortgage lender. The death benefit decreases as your mortgage balance decreases. So if you have a $300,000 mortgage, the initial death benefit is $300,000. As you pay down the mortgage to $270,000, the death benefit automatically drops to $270,000. As you pay down further, it drops more. This decreasing benefit structure sounds logical at first. You need less insurance as your mortgage balance decreases, right? But it's actually terrible for your family's financial security. Here's why. If you die in year one of your 30-year mortgage, the death benefit might be close to the full mortgage amount. But if you die in year 25, when you've paid off most of the mortgage, the death benefit has dropped so much that it might barely cover the remaining balance. Your family loses the house protection benefit precisely when they might need it most because you're older, sicker, or facing other financial challenges. But that's not the core problem. The core problem is the cost. Mortgage protection insurance costs significantly more per dollar of coverage than a standard term life insurance policy that you could buy on the open market. A term life insurance policy is a straightforward product. You buy coverage for a fixed term, usually 20 or 30 years, for a level death benefit that stays the same throughout the term. For most healthy people, a 30-year term life insurance policy is dramatically cheaper than what the lender is trying to sell you for mortgage protection. Here's a concrete example of how expensive MPI actually is compared to the alternative. Let's say you're a 40-year-old home buyer in good health. You get a mortgage with a lender who offers you mortgage protection insurance. The lender quotes you $100 per month for the MPI, which would cost you $360,000 over 30 years. That's $100 a month every month for 3 decades. Now, if you instead bought a 30-year term life insurance policy for $400,000 on the open market from a reputable insurance company, you'd likely pay $20 to $30 per month, maybe $35 if you have certain health conditions, but generally way less than what the lender is quoting you for MPI. Over 30 years, you'd pay $7,200 to $12,600. Instead of $360,000, you're paying a fraction of that for coverage that's actually more robust and more flexible. The difference is not a small amount. We're talking about potentially $350,000 in savings over the life of the mortgage. For a family, that's a house down payment. That's a college fund. That's a retirement account. And almost nobody knows they're throwing away this amount of money because they've never shopped for the alternative. The mortgage lender presents MPI as a standard product. People sign it without comparison shopping, and the lender makes a huge commission on the policy. It's genuinely one of the easiest ways lenders make money off borrowers, because most borrowers don't even know it's happening to them. It's bundled into the mortgage process, it's on the disclosure documents, and most people are overwhelmed by all the closing documents anyway, so they just signed. Now let's talk about why mortgage protection insurance is particularly problematic from a consumer standpoint. The biggest issue is that it's medically underwritten at the time of mortgage closing. But here's the thing: you have guaranteed acceptance without a medical exam. That sounds good until you realize what it actually means. No medical exam means the insurance company can't assess your actual health risk, which means they price the policy assuming you're a worst-case scenario for your age and gender. They price it assuming higher risk, which means means higher premiums. A standard term life insurance policy, by contrast, will typically require a medical exam. The exam is usually quick and non-invasive. You answer health questions, maybe get a simple physical, and the insurance company uses that information to price your actual risk. If you're actually in good health, you get better pricing because your actual risk is lower than the worst-case scenario. The irony is that most people in good health will get better pricing with a medical exam than they will with guaranteed acceptance. There's also the issue of no comparison shopping. When you get your mortgage quote, you get one MPI quote from the lender. You don't get multiple quotes. You don't see pricing from different insurance companies. You don't have the ability to shop based on your actual health and risk profile. You just get offered whatever the lender has, usually with a hefty commission built into the premium that goes to the lender or the broker, not to the insurance company. And then there's the biggest issue, the decreasing benefit problem. As your mortgage balance goes down and your family's other financial needs potentially go up, your insurance coverage goes down. Your kids are getting older, your expenses might be increasing with inflation, but your death benefit is shrinking automatically. By the time you're in year 25 of a 30-year mortgage, your coverage has declined so much that it might not actually protect your family the way you thought it would. Let's talk about who's actually benefiting from the mortgage protection insurance system, because understanding the incentive structure explains why it's so pervasive. The lender benefits enormously. Mortgage lenders, or the brokers they partner with, earn commissions on MPI policies. These commissions can be substantial, sometimes 50 to 75% of the first year's premium. If you're paying $100 a month for MPI, $50 to $75 of that first month is a commission that goes directly to the lender or broker. That's a huge incentive to push the product. The insurance company benefits because they're collecting premiums on a product that most people have no comparison for. There's no price competition because most people don't know they can shop elsewhere. The insurance company quotes one price, the consumer accepts it, and the insurance company collects $360,000 from that one customer over 30 years, when they could be providing comparable coverage for a third of that cost and still make a healthy profit. The mortgage broker benefits for the same reason, commissions on MPI sales. These commissions are a significant component of their total compensation. If they close a mortgage and sell MPI, they make more money than if they close a mortgage without MPI. So they have a financial incentive to push it, usually without explaining the alternatives or even mentioning that alternatives exist. And the people who lose? The homeowners, the family. You're the one paying inflated premiums for coverage that's worse than what you could buy on the market, and you probably don't even realize it's happening. You think you're protecting your family. You are protecting your family, but you're doing it in the most expensive possible way. Here's the reality of what happens at mortgage closing when MPI is presented to you. You're drowning in paperwork. You're reviewing disclosures, closing documents, title reports, surveys, inspection results, all of it. You're tired. You're excited about the house. The lender or broker mentions MPI as a final add-on to protect your family. It sounds good. It feels responsible. You sign it. You probably don't realize that a few of those documents you're signing could be interpreted as a comparison of alternatives if you read them carefully, but you're not reading them carefully because you're signing 50 pages of documents in a 2-hour closing. You don't know what the alternatives are. You don't know that you could have gotten a 30-year term life policy for a fraction of the cost. You don't know that you're about to lock yourself into $360,000 of premium payments. This is actually worse than ignorance. This is weaponized ignorance. The lender knows that you're overwhelmed. The lender knows you won't shop around. The lender knows you'll accept their quote without question. And the lender profits from exactly that dynamic. The other massive issue is that you're signing up for MPI at the exact moment when you're most vulnerable to sales pressure and least able to think clearly. You've just gotten approval for a mortgage. You've already picked out a house. You're emotionally invested. Walking away from the mortgage is no longer an option in your mind. So when the lender says you need MPI to protect your family, you just agree. It's the path of least resistance at exactly the moment when the lender knows you're most willing to just agree to anything. Now let's talk about what the better alternative actually looks like, because understanding the alternative is crucial if you want to avoid this trap. A term life insurance policy is a straightforward product. You pick a coverage amount, usually a multiple of your income, or an amount based on your liabilities. You pick a term, usually 20 or 30 years, and you buy the policy from an insurance company, either directly or through an insurance broker. The underwriting process involves a few health questions and often a medical exam, but this exam is quick and non-invasive. You answer questions about your medical history, your smoking status, any medications you take, maybe some family history. You get a quick physical or blood test if needed. The insurance company uses this information to underwrite your actual risk and price your coverage accordingly. Once you're approved, your premium is level for the entire term. If you buy a 30-year policy, your premium doesn't change for 30 years. This is completely different from MPI, where the benefit decreases but the premium stays the same. With term life, both your premium and your benefit stay level throughout the term. This is actually what you want. Your life insurance coverage shouldn't be shrinking while you're paying the same premium. premium. And here's the biggest advantage: you can choose your coverage amount independent of your mortgage balance. If you need $400,000 in coverage to protect your family, you buy $400,000 in coverage. You don't need to worry about your mortgage balance or how the coverage will decrease as you pay off the mortgage. You have the coverage you actually need, and your family gets the protection you intended. The cost difference is staggering when you compare apples to apples. For a healthy 40-year-old, a 30-year term life policy for $400,000 costs somewhere between $20 and $40 per month depending on your health, your smoking status, and the insurance company. That's $240 to $480 per year, or $7,200 to $14,400 over 30 years. Compare that to mortgage protection insurance. The same person would be quoted $75 to $150 per month for MPI, depending on the mortgage amount. For a $300,000 mortgage, you'd typically be looking at $100 to $150 per month. That's $1,200 to $1,800 per year, or $36,000 to $54,000 over 30 years. The difference between a term life policy and MPI for the same coverage amount is often a difference of $30,000 to $50,000. And the term life policy is actually better because the benefit doesn't decrease as your mortgage balance decreases. You have consistent coverage throughout the term. This is genuinely one of the biggest financial mistakes people make without realizing it's a mistake. It's a $30,000 to $50,000 decision that happens at closing while you're overwhelmed with paperwork, and the person selling you the product has a massive financial incentive to sell it to you without mentioning alternatives. And now, let's talk about some specific scenarios where MPI is particularly bad, because there are situations where it's not just expensive, it's genuinely harmful. Scenario 1: you're a young homebuyer in excellent health. You're in your 20s or 30s, no health conditions, you exercise, you don't smoke. For you, the difference between term life insurance and MPI is absolutely massive. A young person in excellent health can get term life insurance for dirt cheap, like genuinely cheap, $15 to $25 a month. But you're being quoted $100 a month for MPI because the lender is pricing it assuming worst-case scenario without a medical exam. You're literally paying 5 to 6 times more than you need to pay because you couldn't be medically underwritten to show your actual health. This is especially frustrating because young people are the most price-sensitive borrowers. You're already stretching your budget to afford the down payment and the mortgage. You don't have extra money, and you're losing $50 to $80 a month on MPI that you could save by shopping for term life. Scenario 2: you have a health condition but it's well managed. Maybe you have diabetes or high blood pressure or some other condition that's controlled with medication. You're worried that if you get medically underwritten for life insurance, you'll be penalized. So MPI's guaranteed acceptance without a medical exam sounds good. But here's the reality: you can still get term life insurance through a broker who knows how to shop your health condition. Some insurance companies actually prefer certain health conditions because they're so common and well managed. You might not get the absolute lowest rate, but you'll get a dramatically better rate than MPI, and you'll get better coverage for less money. Not getting medically underwritten for life insurance is generally not a good strategy. It usually costs you more money than it saves. Scenario 3: you're older, you're in your 50s or 60s, you have some health issues, and you're getting a mortgage. This might seem like a scenario where MPI actually makes sense. You can't get medically underwritten, so maybe guaranteed acceptance is better. But even in this scenario, you're probably better off getting term life insurance through a broker who can shop your health condition. The cost of term life insurance does increase with age and health issues, but it's usually still cheaper than MPI. And even if the term life insurance is slightly more expensive in monthly premium, you have more control over your coverage amount and your benefit structure. You're not locked into a decreasing benefit while you pay a level premium. There's also the scenario of income replacement. MPI only pays off your mortgage, but if you die, your family needs more than just to keep the house. They need income to pay for groceries, utilities, property taxes, insurance, childcare, everything. A term life policy that covers your full income replacement needs is actually what you should be buying, not a policy that just covers your mortgage. Your family's financial security depends on income replacement, not just keeping the house. So in almost every scenario, even the scenarios where MPI sounds like it might make sense, you're actually better off shopping for term life insurance elsewhere. The only people who truly benefit from MPI are the lenders and the insurance companies. Everyone else loses. Let's talk about how to actually avoid this trap if you're getting a mortgage or if you already have MPI and want to fix it. First, if you're in the mortgage process right now, you need to specifically ask your lender whether MPI will be offered to you at closing. Ask this question before you go to closing. Don't wait until you're sitting at the closing table with a pile of documents in front of you. Once you know MPI will be offered, you do 3 things. First, you get a quote for a term life insurance policy from an insurance broker before closing. This usually takes 20 minutes. You go online, answer some health questions, maybe schedule a quick phone call or physical exam if needed, and get a quote. You get a quote for a 30-year term life policy that covers your mortgage amount, or ideally, more than your mortgage amount to cover income replacement. Second, you compare the term life quote to the MPI quote the lender gives you. The difference will usually usually be obvious. The term life policy will be significantly cheaper. Third, you tell the lender that you're declining the MPI and that you have term life insurance already. You bring proof of the term life policy to closing if needed. The lender might push back. They might tell you that you're making a mistake, but declining MPI is your right. You can protect your family with your own term life insurance. If you already have MPI, you can cancel it, and many people should. Check your mortgage documents to see if there's a cancellation process. Some lenders make it easy, some make it difficult, but canceling MPI that you don't want is possible, and you should probably do it if you have the option. Now let's talk about what to actually do if you're canceling MPI and buying term life insurance. Once you have a term life policy in place, you can request that your lender cancel the MPI. Some lenders will do this immediately. Some require that you have proof of outside life insurance before they cancel. Either way, it's doable. Here's what you need to know about shopping for term life insurance. You should compare quotes from at least 3 different insurance companies. Insurance brokers can shop multiple companies for you, which is much easier than going to individual insurance company websites. A good insurance broker won't charge you anything. They make their commission from the insurance company if you buy the policy. When you're shopping, be consistent in your quotes. Quote the same coverage amount, the same term, and the same health information to all 3 companies. This lets you actually compare pricing. Don't just go with the cheapest quote. Check the financial stability ratings of the insurance companies. An A-rated insurance company from AM Best is what you want. Your term life insurance policy is a simple product. You pay your premium. If you die during the term, the insurance company pays the death benefit to your beneficiary. That's it. No complexity, no decreasing benefits, no hidden surprises. It's straightforward and it's almost always cheaper and better than MPI. Let's talk about the financial impact of making the right decision here, because the numbers are significant. If you're a 40-year-old getting a 30-year mortgage and you choose term life insurance instead of MPI, you're potentially saving $30,000 to $50,000 over the life of the mortgage. That's money you could put toward paying down your principal faster. That's money you could put toward retirement savings. That's money you could put toward your kids' college fund. For a family, that's genuinely life-changing money. That's the difference between retiring at 65 or being able to retire at 62. That's the difference between helping your kids with college costs or leaving them to figure it out on their own. That's the difference between having a comfortable retirement and stretching every dollar. And the thing is, this is money you wouldn't have to sacrifice anything to save. You're not cutting back on groceries or canceling your gym membership. You're just making a smarter shopping decision. You're comparing 2 products that serve the same purpose and choosing the better, cheaper one. That's good financial decision making. That's exactly what you should be doing with every major financial purchase. The compounding effect matters too. If you invest that $50,000 in savings over 30 years into a diversified investment account at historical market returns of 7 to 8% annually, that could grow to significantly more. We're talking about potential for 6 figures of additional wealth just from making one good decision at closing. Here's the bigger lesson underneath this entire topic, and it applies far beyond just mortgage protection insurance. Financial products are sold to you in moments when you're most vulnerable to sales pressure and least able to think clearly. The mortgage closing is a perfect example. You're emotionally invested in the house. You're overwhelmed with paperwork. You're tired. You're just trying to get through the process. This is exactly when lenders offer expensive, profitable, inferior products to you as if they're normal, necessary parts of the mortgage process. And if you're not actively aware of what's happening, you'll accept it. Most people do. The solution is to actively shop alternatives before you're in a vulnerable moment. Before you go to closing, you should already have alternatives identified. Before you're sitting across a desk from a lender with a commission incentive, you should already know what the better option is. This principle applies to every major financial product. Always shop before you're in the pressure moment and understand the incentive structure. If someone is making money by selling you something, they have a financial incentive to sell it to you, whether it's in your best interest or not. This is especially true in financial services. A broker who makes a commission on MPI has a direct financial incentive to sell it to you. That doesn't mean they're bad people, but it does mean their interests aren't perfectly aligned with yours. Knowing that changes how you should approach their recommendations. If breaking down financial products to understand exactly how they work, who benefits, and whether they're actually worth buying, is useful to you, that's exactly what this channel is built around every single week. Mortgage protection insurance is one example, but there are dozens of these financial products sitting in your life right now, quietly costing you thousands of dollars because you've never shopped around or questioned whether there's a better alternative. Subscribing means you won't miss the next breakdown. More importantly, it means you're getting someone who's specifically focused on finding these hidden costs and inefficiencies in financial products and explaining them clearly. Before you go, drop a comment and tell me honestly, are you currently paying for mortgage protection insurance, or did you avoid it? If you avoided it, how did you know to say no? If you are paying for it, does knowing about the term life insurance alternative change how you feel about that decision? These questions tell you a lot about how many people are silently overpaying for financial products products without realizing there's a better option available. See you in the next one.